Hello, in this video we're going to look at the costs of inflation. First, we're going to start with a fallacy, the lost purchasing power fallacy of inflation. A common complaint about inflation is that it makes people poorer because everything costs more. However, a rise in the price level increases the prices paid by buyers and received by sellers, including those who sell labor services, that is, workers. Because wages tend to keep pace with inflation, purchasing power would remain unchanged. Real wages, that is, wages adjusted for inflation or purchasing power, are a function of productivity, and productivity depends on capital, human capital, your education, your skills, technological knowledge, and natural resources. Money neutrality is the idea that real wages are not affected by a rising price level from inflation because nominal wages increase with the price level to keep real wages unchanged. When inflation is completely anticipated, all prices, including nominal wages, rise by the inflation rate, leaving real values unchanged. As nominal wages increase to compensate for inflation, goods and services will be no less affordable. Some people may experience a loss in purchasing power, however, with unanticipated or unexpected inflation. Imagine workers whose wages are locked into a long-term contract where the contract didn't foresee the high inflation. Retirees whose pension payments are not indexed to inflation would also experience a loss in purchasing power. In both cases, the firm benefits by paying lower real wages and lower real pension benefits, a transfer of income from workers to firms. All right, let's start with the cost of inflation. There are shoe leather costs of inflation. The idea that inflation reduces the value of currency, so people hold less money at higher inflation rates by keeping more of their wealth in interest-bearing accounts. Holding less money may result in more trips to the bank, the idea that people will wear out their shoes as a result, and more financial transactions, transferring assets out of an account in order to make a purchase. There are costs to this inconvenience, including lost time. Firms may want to minimize cash holdings because of inflation, incurring costs of additional staff, using cash management systems, and of course there are time costs with this. Interest-bearing checking accounts have reduced shoe leather costs. Shoe leather costs are thought to be small for low to moderate inflation. There are menu costs of inflation. When the price level changes, firms need to update their prices by printing new menus, catalogs, informing their customers. Changing prices takes time and can be costly. Printing costs, informing dealers, customers, and also the cost of dealing with annoyed customers. Some firms may have small menu costs, so it is easier for them to change prices. Gasoline stations, for example. On the other hand, other firms may have higher menu costs, maybe supermarkets that need many resources and lots of time to change the price tags on thousands and thousands of items. There are price distortion costs owing to inflation. Because of menu costs, some firms may postpone price changes. These firms will have artificially low prices compared to other firms that update their prices more frequently during periods of inflation. If one firm or industry is quick to raise its price and another firm or industry is not, the relative price between these firms or industries gets temporarily distorted. Relative prices affect resource decisions. Consumers make purchase decisions by comparing prices across different products and firms. So for example, in this table, we have two firms. Firm A has lower menu costs, firm B higher menu costs, and we start the year in January. Both firms charge $10 for their products, so the relative price, firm A's price divided by firm B's price, is just 1. We've experienced 10% inflation during the first half of the year, so firm A raises its price by 10% to $11. Firm B, because of the higher menu costs, postpones changing its prices maybe till the end of the year, and in this case, the relative prices now get distorted. Continuing, resource owners may decide to allocate resources to an activity because of these distorted price signals, thinking something is relatively more profitable than it really is. As relative prices become distorted, resources get misallocated in the economy. People may confuse price changes from inflation with changes in supply and demand, again leading to a misallocation of resources. Tax distortion. Unlike income tax brackets that are adjusted upwards or indexed for inflation to prevent bracket creep, paying a higher tax rate because of higher nominal income but not real income, other parts of the tax code do not adjust for inflation. Capital gains taxes are not indexed to inflation. If a person purchased a $100 stock and sold it for $110 at the end of 1 year, the person would pay a tax on that $10 of capital gains. If inflation also increased by 10% over this period, the stock price just kept pace with inflation, leaving the real value of the stock unchanged. This person has 10% more dollars because of this investment, but if everything costs 10% more, the person is not richer and will not be able to command more goods and services. Consider two saving scenarios. We're going to assume a 20% tax on nominal income. So in scenario 1, the nominal interest rate is 6%, the inflation rate 2%. 6 minus 2 leaves a real interest rate of 4%. In scenario 2, nominal interest rate 10%, inflation rate 6%, real interest rate is 4%. So on a before-tax basis, both investments are equivalent, providing a before-tax real return of 4%. But with inflation and the tax code, people are going to be taxed on the nominal gains. So looking at the after-tax real interest rate here, 1 minus the tax times the 6% nominal interest rate, minusing the inflation rate, leaves an after-tax real return in scenario 1 of 2.8%. But in scenario 2, their after-tax real return is much lower. And to look here at the effective capital gains tax in scenario 1, it's going to be 30%. Okay, you only get to keep 2.8% of this 4% return, or in other words, 1.2% is being taxed away, and 1.2% as a fraction of 4 is going to be 30%. And in scenario 2, the effective capital gains here is 50%, not 20%. So this is going to be a disincentive to save and invest. So the lower after-tax return reduces incentive to save and invest, reducing capital formation, and will have a negative effect on economic growth. Not adjusting capital gains for inflation reduces the level of saving in the economy. The tax code does not allow firms to take more depreciation when inflation rises, which increases a real tax payments and reduces a firm's profitability. Firms may reduce their investment in new buildings, factories, and equipment as a result. Counterproductive policies. Governments may institute price controls to try to combat inflation, creating shortages, supply disruptions, reductions in product quality and service, and just an overall inefficiency in the allocation of resources. There are confusion and inconvenience costs owing to inflation. Economic transactions are measured in terms of money. When the price level increases, money loses value, making it difficult to compare prices, including profits and wages over time. Inflation creates confusion. It would be like changing the definition of 1 foot from equaling 12 inches to equaling 7.75 inches. All measured distances would increase, but comparing distance over time would be much, much more difficult. Because measuring firm profitability becomes more difficult with inflation, there's more uncertainty in where investors should allocate their resources in the economy. This leads to inefficiency. Retirement planning becomes more difficult with inflation. What will be the value of my dollars in my retirement account in 10, 20, or 40 years? Unfair redistribution of wealth. With unexpected inflation, if inflation was expected, the interest rate on the loan would have been higher. So with unanticipated inflation, people with loans, for example, mortgages or car loans, student loans, they're going to pay back their loans with dollars that have weaker purchasing power, lowering the real cost of the loan. So in this case, the borrowers or the debtors benefit at the expense of the lenders or creditors. Just a note on high and variable inflation. A stylized fact is that countries with high inflation also have inflation that is quite variable, jumping around from year to year. When inflation is high and volatile, maybe one year it's 15%, next year 35%, the following year 20%, it will make investing very risky. The profitability of investing in capital will be hard to determine, so many long-term decisions will be canceled, and again, a reduction in investment and capital formation. Okay, that's it. I hope you found this video helpful.